Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 83 of Carson's Facts versus Feelings. Ryan and Sonu. Sonu, I think we're all happy that you're here because if anyone follows you on X/Twitter, you were on an airplane that literally had the wing duct taped, and you're not making it up. The wing, I saw it. I said, "Oh no!"
There was a picture. I took a picture.
I said, "Oh no!" Tell me it's not a Boeing and it's not duct tape. But I mean, how you made it? How'd that go?
Well, I look outside my window. This is after the plane took off, and suddenly, wait, surely that cannot be duct tape. And well, that's what I thought. I was like,
it's not part possible.
So the engine's housed in this pod, which is underneath the wing, and so I was like, wait, is it really duct tape? And I was like, okay. And then you have this little nervous feeling throughout the flight. It's like, open holes, we're going 600 miles per hour, whatever it is, right?
It's cold. It's cold up there. Is duct tape work in the cold? I have no idea. I guess.
I'm here. It worked. But it turns out, I put this on Twitter, and Twitter is fantastic, right? Because there's always somebody is like, actually, it's not that. It's not duct tape. Turns out it's aluminum speed tape. I've never heard of it. And I started with aerospace engineering. I did mechanical engineering.
Yeah.
That never came up in coursework. So, but practicality rules over theory and academic stuff, right? So there you go. In reality, engineers use aluminum speed tape to cover over cracks or whatever.
So
on planes.
You're literally like a trained rocket scientist, I think is what I like to say. And you've never heard of using tape on one of the rockets that they taught you about many, many years ago. So I think that makes me feel better. But I'm glad the listeners of the podcast are glad. And if you don't believe us, go look at Sonu's Friday afternoon, Saturday. When did you send that out? Sometime.
I think it was Sunday. Yeah, I was back from Nashville.
Yeah,
so I went to see some buddies out in Nashville.
Well, listen, Nashville can be a wild town. You might have just been seeing things you didn't think you were seeing, but you did indeed see.
I took a picture. Yes,
pictures are real.
So for all listeners out there, if ever you see something like that on the plane, chances are it's not duct tape. It's aluminum speed tape. You see, you learn something new every day. I didn't know about that up until day before yesterday.
Well, there we go. So let's you know what? Let's build it out. Let's let the listeners learn some more things that they didn't know as of a couple days ago. Sonu, we're going to title this one "Buy in May and Stay." Obviously going to be a playful discussion about sell in May, go away. We'll start with that discussion. We had some GDP numbers last week that came out for the first quarter. The first quarter is getting weaker. They tell us. You're going to dive in and show maybe why that's not necessarily the case or so easy. Maybe look at spending and incomes as well. Then a discussion on inflation, the Fed's favorite measure of inflation, core PCE, came out last week. And then the Fed also, by the time people listen to this, might have already had an interest rate policy. Not going to do anything in all likelihood, but still, what are they going to say? So we'll kind of finish up with that. But again, let's start with sell in May, go away. Now, I've got a bunch of numbers on this. So while I pull these up, you want to kind of give your high level sell in May, go away. Should we believe these things? Should we not? What do you think of sell in May, go away? Then I'll talk for a while.
I mean, a lot of these market cliches are just that. It's cliches, but you always wonder. There's probably some, what do they say? There's if there's smoke, there's something there, right? I mean,
if there's duct tape, there's a problem, I think is the one that I've heard before. But yeah.
There you go. But it's coming from someplace. So I imagine 10, 15, 20 years ago, whenever sell in May, go away first came into place. I mean, maybe there's something going on in summer. Maybe people took off in the summer. There was low volume, whatever. I have no idea. But maybe there was some truth to it way back when, but clearly not recently, right, Ryan?
No, that's exactly right. So again, by the time people listen to this, you can go to carsongroup.com/research. And I'll have a blog. I think I've got 8 or 9 different charts and tables, really breaking down sell in May, go away. Now, the truth is this, the next 6 months. So again, that's May through call Halloween, October. Up 1.7% on average. That is the worst of all 6-month combos. The best is November to April, which is up
and
almost 7.
And this is the S&P 500.
Sorry, this is the S&P 500. Good call out there. Thank you. Yes. Up 6.9% for those best 6 months. Now, these next 6 months are higher about 65% of the time. So, Sonu, we're going to dive a lot more in, but I'm just going to start with this question to you. I mean, 1.7% the next 6 months. I don't know. I mean, we've had a good start to the year. I mean, should we? I mean, if you know you're up on average, we totally disagree with just selling and going away. I want to be very clear, but I mean, up 1.7%. That's better than a poke in the eye, right?
Yeah, especially considering what we did, 27% or over the last 5 months, 6 months, something like that. And then you add on 1.7. Yeah, I'll take it. I'll take even zero at this point. No, considering how far we've come, how quickly we've come.
Listen, you're just happy to be alive. I mean, you'll take a bear market after that. No, we don't want a bear market. I'm teasing.
No.
But so a few more things just for the listeners to think about sell and may go away, because you're going to hear a lot about it. I've got CNBC right over there. No, they're talking about the ECI data. I know you haven't had time to jump in, but I guess we'll get into that. We'll get into ECI also at the time we're recording this when we talk about inflation here next. But just think about this. So the next 6 months is the sell and may go away period. The S&P 500 has been higher. You ready for this? 8 out of the last 10 times, and up 4% on average. So it's more than double the 1.7 we've seen since 1950. I do see 22, not surprisingly, 22 is a bad year, but lost about 6% during that time period. 2015, virtually flat. All the other years, the last 10 years, saw gains, in a lot of cases, fairly decent gains during those times. Here's another one for you. Maybe we should call it sell in June, because the month of May, and believe me, this maybe it's random, maybe it's not. Just be aware of this. The last 10 years, stocks have been higher in May, and this actually surprised me. So we bring in here when I looked at the last here. Maybe you don't know, because you probably peered my blog. Maybe you don't know off the top of your head. Which year out of the last 10 was negative in May? Do you know by any chance?
I remember that one. Was it?
This surprised me.
Can I guess? 2013.
Hey, we guess all the time. Well, first off. You know, it's funny. 2013 is not in the last 10 years, Sonu. So right away. Yes. I mean, 2014 was 10 years ago. Oh, I know. Right. Only a rocket scientist can come back.
I would mess that up.
No, it was actually this surprised me. So I want to talk about this for a minute here. It was 2019. 2019. Really? When I think back to 2019, and you and listeners, believe me, we think, oh, that was a good year, because it was a really good year. Stocks lost 6.6% during the month of May in 2019. Every other May has been positive. But just talk about that. I mean, you think back in history, 2013, 2019, 2017, 2021, 2023. Those are all good years. I was really surprised to see that big of a pullback in May of 2019. I have no idea why it happened, but I guess it just happens, right?
Interesting. Yeah. I'm trying to think what happened in 2019, May. But anyway, it doesn't matter. That's the whole point of this.
Who knows? Right. Yeah, it can happen, and we've talked before. Most years, on average, see a 10% correction. You see, 7 different 3% mini little pullbacks and 3 5% pullbacks. We just had our first 5% pullback, or mild pullback, so I should call it. Just a week or two ago, we talked about that on the podcast last week. We also talked about why we saw some positive things taking place, and sure enough, we had a big rally in equities last week as a result, and we still don't totally, we're not on camp that we're going to see a 10% correction here. We're closer in the neighborhood. But you can listen to last week's podcast where we talk more about that. A few more things here, Sonu, and I'll kind of bring you in as we go around these. It's an election year, in case anyone is living under a rock and didn't know that. It turns out during election years, you tend to get a pretty strong sell in May period, and you get a summer rally. Those next 6 months that are an election year, Sonu, are up 2.3%. Now, that is actually the second best out of all the 4 years of a presidential cycle. First year, midterm, pre-election, then election year. But they're also higher almost 78% of the time. Now, your midterm year, think back to 2022. That was pretty ugly, right? Midterm years are virtually flat, actually down a little bit these next 6 months, and higher about a coin flip of the time. So it's normal. And you look at another chart I shared on the blog, June, July, and August. You know what happens? You tend to see a pretty darn good rally on the S&P, at least, in an election year. And here's one I bring you in now, Sonu. Looking out a little further, September, we know it's kind of a rough month historically, but October is like the worst month, hands down, in an election year. You want to take a wild stab at why that might be?
I mean, uncertainty is worst thing. Uncertainty is what markets don't like, right? I know it's a cliche, like markets don't like uncertainty, but that's true to an extent. As we get closer to the election, especially September, October, that's when the noise level goes up. I mean, I was looking at there's something called the fear gauge in markets. It's the VIX index. It measures what option markets think the next 30 days volatility for the S&P 500 will be. That's essentially, if it goes up, that means people are fearful that there's more volatility expected over the next 30 days. Now, if you look at September and October, the difference between what people expect for volatility for the VIX index, it's much higher in October. There's a big spike in October, and then it comes down. Well, that always, looking back, that happened in 2012, 2016, 2020. This year, it's actually slightly higher than what you'd normally expect, normal being the last 3 election cycles. Whether you think that's normal or not is a whole other thing. But all this to say, volatility there's more uncertainty during that time. Markets expect more volatility as well.
It might kind of seem normal now, but there's more time. There is more time coming. And I remember this in 2016, the Dow had like an 8 or 9 day losing streak directly ahead of the. Now, honestly, it was like a lot of small cuts. I want to be very clear, but still persistent selling. 2020, let's think back to that time frame, right? We had that big rally off the COVID lows, but we had more, worry, indigestion, VIX spike. Of course, I mean, it's the election, right? And we wouldn't be shocked. In fact, I think I'll put it this way: we would be more surprised if we just had a nice calm October and everything was fine. I don't think anybody is anticipating that. Maybe
it's funny to think we're in 2024. I mean, that's why I thought 2013 was in the last decade. Like it just isn't registered inside that. We're 20 in 2024. We're not in 2020 anymore. It's like the last 4 years didn't happen or something. I don't know.
I think it means we're getting older. I think it's what it means.
Okay. I don't want to accept it.
Yeah, I know.
Yes.
So let's see. Let me just look at a couple more here on Sell May Go Away. Then we'll talk a little about the economy. This is one that I think is really powerful, and the idea of momentum. We've talked a lot on this podcast about momentum can get momentum on both ways, both sides.
Yep.
So all years, the next 6 months, the worst 6 months of the year, up 1.7% on average. We said that a minute ago, up about 2 out of every 3 times. So just have that in there. So when you're up year to date, just coming into this period, so you're having an okay year. You're up year to date. The next 6 months are up 4% on average, higher 3 out of every 4 times. And when you're up more than 4% year to date, like we likely will be, unless barring a major sell-off here on Tuesday, the time we're recording this, the last day of the month, up 4% for the year. So pretty solid start to the year. You're up about 78% of the time the next 6 months, and higher 4.2%. So things get a little better. But here's what I want to bring you in, which is interesting, I think. If you're down for the year going into these next 6 months, again, like we're not going to be this time. We were in 22, by the way, and some of the worst sell-offs ever were that way. The next 6 months are down 2.3% on average, higher only 46% of the time. Is it as simple as momentum begets momentum? I mean, kind of seems like it sometimes, right?
I think so. That's what I like to say. Momentum begets momentum. All else equal, yes, you can have your, macroeconomic story. And I certainly do. I mean, we do as a team as well.
Oh, yeah.
But you always want to pay attention to what markets are saying. And then, markets are telling you that things are sort of okay. The macroeconomic backdrop is okay. The economic growth in the US is strong. In fact, it's stronger than, in the rest of the world. And so earnings have been coming out pretty well as well. We're in the thick of earnings season. About half the S&P 500 is, reported. So, yeah, things are well. And we've had good momentum, right? It's not explosive momentum like we saw, like going back to like 1987 or something. I think markets are up, 30-40% in the first 5-6 months. It's nowhere close to that. So this is normal, especially in an election year. What do you expect based on, what's happened? Well, you expect markets to go up.
Absolutely. We're going to dive into that macro backdrop next. But one final thing, something for everyone. So if you think, okay, election years are usually pretty strong. You have the summer rally, at least for these 6 months. And, oh, by the way, when you're up for the year or up 4% for the year, you tend to do better. Here's something for everybody. But we're down in April. Okay. April is like the strongest month. November, I guess, is number 1. April's the second best month. You go back in history. I mean, it's April and November. We're down in April. Okay. I mean, not a lot. We've had a good comeback from the middle of the month to the end of the month. And historically, we talked in this very podcast, the first half of April usually is kind of wishy-washy, a little weak-ish. It's the second half after people do file their taxes. Apparently, the buyers step in, and that played out again. But anyway, when you're down in April, which again is pretty darn rare, it doesn't happen all the time. The next 6 months, Sonu, down 2.9% on average and up only 48% of the time. And are you ready for this? Drum roll, please. 87. Okay. 87 was a year that we did see a negative April. Now we had a great start to the year, like a historic start to the year, and then of course you had the crash crash in October. So believe me, that's just one. We don't think we're in 87 scenario, but there is something for everyone, I think, when you look at this. But our overall stance is, again, maybe a little chop, maybe a little more frustration, but a summer rally by the time we get there still makes a lot of sense to us. Final comment from me, Sonu. The 5-month win streak is likely over, proving once again all good things have to come to an end. So I took a look here, and again, this is in the blog, carsongroup.com/research. When you have a 5-month win streak, then it's over. Then you start the clock after that first negative month.
Okay.
The next month later, so I guess that would be May. In this particular case, be May. It's kind of, little. You've seen some weakness, a little more chops potential, but 3, 6, and 9 months later, all the returns are better than the market average. And 1 year later, higher every time, 6 out of 6. 1 year later, up 9% average, 10.3% median. I mean, those are not extremely bullish numbers, but I think they're also saying, listen, this bull market that we are in, and we've said we're in for a while now, still is alive and well even after a 5-month win streak. Anything you want to add on that? Then we'll maybe talk a little bit, and then we'll start talking GDP.
I guess big picture is, even with April being down, we're up 25-30% thereabouts over the last 12 months.
Exactly.
That's strong,
right.
So it's just a reminder to one of those charts, one of my favorite charts that you show. Average is never the reality in a way. So I'm sort of paraphrasing what you have. Like,
average isn't so average, I think.
Yeah, average isn't so average, right? The
Yeah.
average year returns like 9%, but most years, tend to be above that, right? It's just that when you have a weak macroeconomic backdrop, recession, profits go down, then you get these big bad bear markets. 2001, 2002, 2008, 2009, 2020 briefly, 2022 was another one. But again, that wasn't 2022. We had a quick drop, and then things got back pretty quickly.
Yeah, there's a lot of ways to look at that. I mean, I will say that number you're talking about averages for average. You go back in history, there have been as many 20% gains for the year as there have been negative years. Okay, let's think about that. So again, a gain of 8 or 9%. It's happened, but it would be very, very rare to happen again. All right, so this was a good discussion on sell and may go away. We are not buying it. We again title this one episode 83.
I like that. We're not buying it.
I slept at Holiday Inn Express last night, so I came up with that one. Buy in May and stay, again, is what we're titling this one. Let's see here. So some more good news from Carson. We talked last week about Bert White being promoted to CEO, so congrats to Bert. Carson Wealth, was named USA Today number 28 out of 500 our top RIAs in the country. And if you look at just $5 billion AUM, we're number 11. So the continued momentum. We've just hired some really awesome executives as well. You can go look in the news and find that. So there's definitely been a lot of positive momentum here at Carson. We're really excited about that. Number 28's not bad. I mean, we need to work. We can keep going, right, Sonu?
Yeah. But there are like 32,000 firms or something like that.
Yeah, something like that. Yeah.
No, congratulations to everyone at Carson. This is huge. I mean, to all our advisors. I mean, we like to say that we're big, but not so big that we don't have a community. I think we have a really nice community. You and I are going to be in Omaha next week for our biannual, is that the right term for it? Biannual Partners Summit, right? Where everyone gets together, we get to interact with our advisors. So that's like I said, it's a wonderful community. And thank you to all our advisors who I know listen to the podcast as well. So congratulations to all of you.
Absolutely. And if you're an advisor in the industry looking around, seeing, wow, that looks like they're having some fun over there and they're making an impact and they're helping their clients, go to carsongroup.com, check us out. We'd love to talk a little bit more. All right, so that's some good news there. Let's talk now about GDP. GDP in the first quarter came in at I'm going to say only, air quotes, only 1.6%. It was supposed to be over 2.5% approximately. It would have been the 7th consecutive quarter of over 2% real GDP growth. It wasn't. That would have been the longest streak, Sonu, in over 20 years. You've had plenty of time to dive in. Believe me, you've done plenty of work on this for our Carson partners, and your daily note that you send out on the blog that we do and the morning calls that we do for our advisors. It wasn't so bad, was it? It really wasn't as bad as they made it sound, was it? Take it away for a little bit, Sonu. Let's talk GDP.
Yeah, let's put this in perspective, right? So between 2010 and 2019, GDP economic growth after adjusting for inflation. So we're talking real GDP growth, right? Real meaning it's adjusted for inflation. Trend growth was about 2.4%. And Q1 came in at 1.6. The fourth quarter of last year was 3.4%. So you look at all that, you're like, wait a minute, did the economy really slow down that much? Well, it turns out no. Short answer, no. So GDP is made up of 5 basic things. So you have household spending, you have business spending, government spending, and then you have 2 volatile pieces, which is inventories, right, and net exports. Inventories are like how much companies have in their, you think about it like warehouses, and then it's valued, based on different measures, metrics, things like that, right? Now, GDP actually measures the change in inventory. So inventories increase from this quarter to the next. That's a good thing, normally you would think.
Sure.
But if it increased this quarter less than how much it increased in the previous quarter, then it's a drag on GDP. And that's basically what happened. Inventories pulled down GDP growth by about 0.35 percentage points. Net exports, which is, the US imports a lot more than it exports. So net exports is usually a drag on GDP growth. And so it was this time, except this time it was a huge drag. It would pull down GDP growth by 0.86 percentage points. Why did that happen? Because imports surged. By the way, that is a sign of stronger demand. If the economy is weak,
I mean, people are buying our stuff, right? I mean, we're buying stuff. I said we're buying stuff. We're buying stuff. I apologize, said that wrong.
I mean, ideally, we'd buy a lot more, stuff that's produced in the US, but there's not enough of that. So we go look abroad and we buy a lot more from abroad. And that increases imports. That's a sign of a stronger economy as opposed to a weaker economy. When you think about a recession, let's say 2008, 2009, you actually see imports fall. You see the trade deficit fall. So I'm not saying having a big trade deficit is a good thing, but temporarily it's a sign of stronger demand, right? So all this to say, inventories and net exports pull down GDP growth by about 1.2 percentage points. Okay. Take both out, you get what's called final demand, right? How much are households, businesses, and government spending? That was up 2.8% in the first quarter. It's lower than what we saw in the fourth quarter. That was running at 3.5%. But like I said, the 2010-2019 trend was 2.4%. So right now, we're running above that, quite a bit above that. Take out government, and you look at just private demand, right? And all this is adjusted for inflation, by the way. That was running at 3.1%, pretty much matching the strength in the fourth quarter. That's huge, right? And one thing, yes, government spending eased in Q1. I mean, people are always like, oh, most of economic growth is because of government spending and all of that. For what? 2 things there. I'll know that government spending counts, right? I mean, so because if the government spends money, that's obviously, they're buying stuff from the private sector as well. That goes to revenues and profits and things like that. Then the other thing is, you can't really take out government spending for exactly that reason I mentioned, right? It's about 18% of the economy, but a big part of government spending is actually state and local government spending. That's actually about 12% of GDP.
And I'll just chime in for a second. That surprised me. I mean, I know you do these notes, so I just assume most of us probably say, oh, the big government, right? The national government. And the big, that's probably, but no, it's actually state and local that are 12% of GDP, our economy.
Yeah, and the federal government is about 6%, right? Now, you think about state and local government, one thing why did government spending slow? Well, state and local government spending in especially investment stuff like whether bridges, stuff like whatever, right? That stuff pulled back. But again, the outlook doesn't look too bad. States are flush with money. Why? 2 things. Property prices are up, so tax revenues are up. People are spending more, so sales tax revenues are also up. Not to mention for those states that have income taxes, people are earning more, right? So income tax is also higher. So states are in fairly good shape. So I think the outlook is fairly good over there. But again, go back, take that out, right? You have strength on the private side, private demand. The cyclical areas of the economy crushed it in the first quarter. You have investment. You and I have talked a lot about investment because that's what you need for productivity growth. Non-residential investment was up just under 3% in the first quarter. You had a lot of spending on equipment, industrial equipment, and technology. Right? You had a lot of spending on software as well. So that was good. That's what we need. That's what we want for productivity growth and a strong economy. But then the other side is housing, right? Housing was a drag on GDP growth for 9 straight quarters in 2021, 2022, into the first half of 2023 as well. For the last 3 quarters, it's contributed to GDP. It's added to GDP growth. This last quarter in Q1, first quarter, housing contributed 0.52 percentage points to GDP growth. That's the biggest addition to GDP since the fourth quarter of 2020. That's despite mortgage rates staying above 6.5%, right? So
Wow.
it just tells you that demand is strong. There's a lot of pent up demand, I think, in the housing market. People want homes. There aren't enough homes. I think that's the story there.
No,
I'll shut up
great.
for a second.
Yeah, no, that was great stuff. So again, the headline they told us last Thursday was the economy's weakening. We would say no. You know, when you kind of peel back that onion a little bit, I do see. I had some notes here. The residential investment, so think housing up 13.9%.
Yeah.
2.8%. That's where you said it accounted for almost 0.5% in GDP. We had consumption running at 2.5%, so still strong. Expected to be at 3 though, so a little weak, but still consumption still strong. But services spending was up 4% versus goods consumption virtually flat, down a tad. You want to build on that? I mean, because we saw services soaring out of COVID times, and it kind of slowed down. And I don't know. I mean, what's your take on services soaring and goods kind of not last quarter?
I mean, services is really like you think about the economy, most of the economy is actually services spending.
Yes.
Right. Including the stuff we spend at home and then recreation, concerts, movies, pet care services, in all of that stuff, personal care, laundry, dry cleaning, all of that is services spending, right? And it makes up 45% of GDP. Right,
Okay.
Goods is about 20 to 22%.
By the way, you just listed like my lunch breaks. Those are the places I go: the dog, the laundry,
I forgot restaurants. Restaurants. That's such a big part of services
yeah.
spending too, right?
We're all. I know most of our listeners are fans of restaurants on this podcast. So
yes.
yeah,
and as you said, services spending was up 4% in the first quarter. That's, by the way, that's the fastest pace since 2021, right?
Okay.
And 2021 was, I would put it in a different category because, that was sort of like revenge spending after everyone was stuck home after COVID, right?
Right.
This is not that. This is like, things are normalized at this point. We've been going to movies for about a couple of years. So maybe me less than Ryan, but
I haven't seen that many. I mean, I saw Expendables. I was heartbroken how terrible the recent Expendables was. I saw Oppenheimer. I can't think. I didn't like. I was one of the only people who didn't like Oppenheimer. I can't remember. I don't know if I've seen any other movies. Honestly,
did you?
Did I see somebody else? Oh, The Beekeeper. I loved it. Beekeeper.
There you go.
That got Ryan seal of approval. Those are the 3 movies I've seen the last few years. But anyway, let's kind of wrap this up.
So
go ahead. Yeah,
service is strong, and you think I'll just wrap it up this way. Why is it strong? It's strong because of strong incomes. Why are incomes strong? We just got wage growth from the ECI, the Employment Cost Index, right? I was just looking at my screen. It was up 4.2% year over year in the first quarter. That's real. That's strong. It's not red hot. We're talking about inflation coming in harder in the first quarter. Well, there were certain reasons. There's shelter, auto insurance prices, things like that. Portfolio management services, prices for all these things went up. Portfolio management services prices went up because the stock market's up. So, financial advisors are charging a little bit more. And there's several idiosyncratic reasons why inflation went up. The big part of, when you think inflation, is that going to be higher? Is it going to be persistent? What is one of the first things you look at? You look at wage growth, right? Wage growth is running about 4%, just above that, as I said, with the Employment Cost Index that came out this morning. That's normal. That's not far away from, that's not much higher than what we had before the pandemic, right? That should tell you that, there isn't too much inflationary pressures from the demand side of the economy, right? But consumption's still strong because, 4.2%, 4% wage growth is still a good number. And like I said, consumption's the most important part of the economy.
Absolutely. So let's kind of finish it up with this. So obviously the first quarter came in weaker than was expected. Although, like we said, you dig in, maybe things weren't as bad, but still the headline is the headline. Our friends over at Bespoke, as always, they dive in, do some really cool work. They showed Sonu that first quarter, and this is called the advanced estimate. So I guess that's the first number. The first time we see a number, that's the first estimate that comes out. They went back 22 years. And the first quarter GDP, again with that first estimate, beat expectations. You ready for this? Only 3 times. If my math is right, 19 times. So I don't know if this was number 20 or not, but nonetheless, this year, it's normal for the first quarter GDP to come in less than expected. Believe me, we could probably talk an hour on why. Let's just say the bottom line, you tend to see the first quarter come in a little bit weak historically, according to our friends over at Bespoke. And the 3 years that actually beat, okay, so came in better, which again, we did not come in better. You ready for this? 2008, last I checked, things did not do so well in 2008. 2018, last I checked, stock market lost 5 or 6%. Not really a good year. And then 2019, things were solid, except for May, as we talked about a little bit ago. Very small sample size. I fully am aware. But I'm just saying, 2 out of 3 of those, the stock market was down. So maybe we should be thankful that GDP did not come in better than expected.
GDP is a hard one. I mean, we'll finish up with this. Like I said, it's hard to forecast it because of those 2 volatile components, inventories and net exports.
Yeah.
But that's why, for all of you looking at GDP, always one of the first things I recommend looking at, look at final demand. It's at the bottom of that GDP report. That's what counts, right? How much are businesses, households, and government actually spending? Where is how much real demand is there in the economy?
Yeah, well said there. So let's see here. We'll take a second here.
What else do we have?
Yeah, I got a couple housekeeping items. Then we'll talk about PCE, inflation, Fed, and wrap things up. I know you've got about 12, 13 minutes here. So help us out by telling us how we're doing. Leave a review, give us a like, and subscribe if you want to hear the latest. So thank you to all the listeners for that. And then also Excel is coming up. We mentioned this last week, Sonu.
Yes.
Excel is our conference. It's open to the whole industry, right? The one we talked about a minute ago, or a couple minutes ago, Partner Summit. You have to be a Carson partner, which if you're not, what are you doing? But that's all right. You've got time. But Excel is in Orlando this coming September. I think it's, Chelsea, September 9th, 10th, 11th. Yeah, 9th through 11th. But yeah, thank you, Chelsea. Chelsea, our producer. She sends us notes to make sure we're talking about what we're supposed to be talking about. You can go to excelconference.com. It's Excel is EXCELL. Then conference.com. Please check that out, excelconference.com. It's a ton of fun. I've heard rumors of some of the speakers. Believe me, there's some big time speakers coming. Sonu and I, in all likelihood, will do a live version of this very podcast with probably a huge guest. We're doing one with Jeremy Siegel in just next week. Like, wow, isn't that cool?
Yeah.
Next week, we're with Professor Siegel next Friday. But again, that'll be recorded. So we'll share it on this podcast sometime down the road. But our partners and everyone,
we have some good ones coming.
We've got some great ones. We're going to do, we've got some big, we're going to interview Bert actually on this podcast as well, which will be awesome to hear about his vision and the future of Carson and some other big ones. But if you've been to Excel before, you know how much fun it is. There's awesome speakers to learn from the Carson community, and again, it's open to everyone. So please check that out. Anything you want to add on Excel, Sonu? Then let's wrap things up with inflation.
Well, it's in Orlando, so hopefully you can mix some business with pleasure too. So hopefully we'll see a lot of you there.
Yeah, no doubt about it. I know lots of people will be there. It's a big one. It's a big conference, so it'll be a ton of fun. All right, so let's finish things up with inflation. You kind of hinted at some inflation things a minute ago with the employment cost index that just came out. But the PCE, core PCE, that's the Fed's favorite measure of inflation. So they tell us, although the media's favorite is CPI, because we sure focus on CPI a lot more. Then there's PPI. I want you to explain what all those are. But so let's talk about CPI, PPI, which has already been out there, and you explain what they are, Sonu. And then what in the world is PCE? What's the difference between them all, and why does the Fed care about PCE more? And what did you see when you looked at that data last week?
They're all oh my god. Okay, I'm going to
all like favorite children, right? Which one's your favorite? You got to, they're all the same.
Let's start with the most popular one, which is coded, which is the CPI, the Consumer Price Index. It measures consumer prices. It actually measures how much consumers are paying for different goods. Yeah. Right, and then you have the PPI, which is a little different. That's the
Producer
price index. I just blanked out that.
That's why it's a 2-man podcast. Yeah, we're gonna over 40 minutes. We're gonna blank out at least twice. And I joke it's like in old school, when Will Ferrell who just blacks out and answers like that really hard question. They go, "You did great." He goes, "What did I just say? I have no idea." That's how this podcast is. 40 minutes later, I have no idea what I just said. Usually turns out okay though. Yeah.
What are you talking about? PPI, Producer Price Index. Thank you, Ryan, for that. So that measures how much businesses are charging or paying for goods they buy from other businesses. So that's a little different from how much consumers are paying. Then you have the Personal Consumption Expenditures Index, which is the PCE index, which is what the Fed, they've been focusing on the PCE index rather than CPI since 2000 or so, I believe.
Okay.
And the PCE it also measures what consumers are paying, but it looks at it from the other side. It looks at it from the perspective of how much a business is charging consumers, right? So it's a little different from how measuring how much consumers are paying. It should be the same thing, but turns out it isn't.
I was thinking, isn't that the same thing? I mean, I'm probably thinking like every listener out there. Aren't they supposed to charge the same thing that they're? If I go buy something at a store and my credit card, that better have a different number. That's all I'm going to say. I don't know.
No.
Well, how does that work? I mean, we getting real the weeds here, but
we are in
I
the
don't know.
weeds. I mean,
Yeah. Okay.
It's just different from how these things are measured, and
Gotcha.
for even if you just take something like airfares, how it's measured in CPI is different from how it's measured in PCE. Health insurance,
Gotcha.
Totally different thing, right? And we can go with one versus the other. Anyway, the Fed started focusing on PCE for a few reasons. One is it's more comprehensive; it's got more categories, and then the other thing is it can be revised. The historical data can be revised as well, and that's part of the reason first quarter inflation was actually harder than expected, because January PCE was revised higher, right? January is already hot, and it was revised, even to be something even more harder than it already was. And then the other reason is PCE, with both PCE and CPI, we're tracking a basket of goods. For CPI, it's fixed. That basket of goods, like if shelter is 43% of core CPI, it's going to stay that way for the 1 year. And then the Bureau of Labor Statistics adjusts the weights of the basket. Whereas with PCE, it's continuously updated. It's more dynamic. If, you and I are going to spend more in theaters watching Jason Statham movies, maybe the weight for movie theater watching theaters goes up, right? Yep. And if you're eating less or something, if you're spending less at fast food restaurants, spending more on, white tablecloth restaurants, I mean, that shows up in the expenditure weights as as they call it as well. So it's more dynamic. These are some of the reasons why the Fed started focusing on PCE as opposed to CPI. Anyway, all this to say, we got core CPI, PCE numbers. We already had CPI and PPI. So we knew first quarter was hard. March is a little harder than we expected. Bond yields have been going up. There's been a little consternation in markets, because maybe the Fed's not going to cut as much. We've gone through that story before. So core PCE ran at 4.4% in the first quarter, right? Over the last 12 months, core PCE is up 2.8%. And it looks like, for the last 3, 4, 5 months, it looks like we haven't made much progress. We've been sitting in that 2.5% to 3% range. And the good news is a year ago, we were at 4.5%, right? So a big picture is we are alone, right? And then you think about, okay, what's keeping core PCE elevated? We've talked about shelter. Food services is another one that's keeping it elevated. But the good news is that's continuing to trend down. You and I have talked about, how I look at food services. It's if you want to pick one category out of inflation and say, okay, what's my bellwether, right? What's the one category I can look at within the inflation basket to tell me, what's happening with inflation? Look at, restaurant meals, right? If you look at inflation restaurant meals, why? Because that's got a lot of different things from the economy going into it, right? It's got commodity prices, food prices, and it's got transportation costs, things like that. It costs, energy prices, right? That goes into transporting food across the country on trucks and things like that. Then you have restaurant worker wages as well. That goes in there. So we talk about wage growth as an input to inflation, and that's correlated as well. And then, you have to rent restaurant premises. So rents go in there in a way. So it's a nice bellwether to look at with respect to trying to figure out, okay, what is the underlying pace of inflation in the economy? Look at restaurant meals, seated restaurant meals. I'm not even talking about fast food or anything like that. That's coming down. That's a good news, right? That's one of the more positive things we've seen inside the inflation data. Then the other piece pushing up core PCE, keeping it elevated. I've talked about this before. Financial services, portfolio management services, prices for that were going up because stocks have been going up, right? That should reverse unless stock prices go up another 27% over the next half year or so, which again, I'm not going to complain if that happens, but if that does happen, we'll see PCE go up again. So there you have it. It gets into, you could ask me what's my favorite measure of inflation, which one I prefer, which one I don't. And I have my opinion for sure. But it almost doesn't matter. What matters, what is the Fed focused on, right, at the end of the day. And because of that, we focus on what the Fed likes to look at. And that's core PCE at the end of the day.
Well said. And by the time people listen to this, that Fed meeting will probably have happened. But just some interesting things on inflation that I saw the last couple of days from some friends of the podcast. Honestly, all of them been on this podcast. Neil Dutta over at RenMac, he listed, everyone's moved so kind of what we talked about last week in this podcast. We went from 7 cuts to now no cuts or maybe some hikes. Now, believe me, the Fed Fund future is still saying it's going to be 1.5 cuts approximately.
Yeah.
But a lot of people on TV, I was on the radio yesterday, they're talking no cuts, maybe hikes. I'm like, yeah, we've swung really far.
Yeah.
Neil says not so fast. Neil points out unit labor costs are still slowing. Inflation expectations are not increasing. They're not really necessarily going down, but they're not increasing. In the 1970s, it was like a self-fulfilling prophecy. People expected higher inflation. They wanted higher wages, and that's exactly what happened. Fortunately, we're not seeing that now. Neil also says wages are slowing. Now, we have the wage data today, popped a little bit, but overall wages are slowing. And Neil also said, hey, we got a strong dollar. Historically, a strong dollar is not what you see in an inflationary environment. Claudia Somm noted year over year, new rent tenant prices have absolutely crashed, Sonu, and then she overlaid OER, owners equivalent rents.
Rent.
Which again has been that stubborn part. That's lagging, but if it follows the trend, that should drastically follow the fall the second half of the year over year, which should be a positive on the inflation front. Then lastly, Tom Lee over at Fundstrat, he found his shop found there were 989 conference calls that used the word inflation. Back, this time 2 years ago, give or take. And he said only in the first quarter, only like 218, or the most recent quarter, only 218. So if there was so much inflation out there, we'd probably be hearing about it more in conference calls, right? We're not hearing about it as much in conference calls. That can change. But when you look at what Tom had to say, what Neil had to say, and Claudia had to say, some 3 of the smartest people we know, they're all saying maybe, to quote Jim Carrey, Dumb and Dumber, you tell me there's a chance. You tell me there's a chance. We've gone too far one way with inflation. Inflation is not just going to come dropping back or crashing back. But hey, maybe again, the opportunity, Sonu, is to go opposite what everyone is saying. And that could be a little disinflation coming forward, maybe a rate cut or two. And that could be a positive for, honestly, probably small and mid caps, right? I mean, if that were to play out, what do you think?
No, I think so. And it gets to finally at the end of the day, I mean, you and I manage portfolios. You manage portfolios for our Carson partners and clients, right? We have 50,000 households. I know a lot of you listen as well. So, how does all this play out in a portfolio? And that gets to the important part thing you brought up. Like, a lot of it is what's priced in, what is not priced in. When you think about markets, right? When you talk about the economy, you talk about inflation.
That's what it's all about. That, to my end of the day, is what it's all about. What's priced in and what's not. I mean, that's what matters.
And then you think about, wait a minute, if all of us want to make money and excess returns more than what you can probably get, if you just invest in passively, so to speak, right? If you just put it in like some ETF or something, and you think about what's not priced in. A year and a half ago, what was not priced in was a strong economy, right? You and I have talked about that.
Believe me, a year ago right now, that was not priced in. That is one way to put it.
I'm almost making it sound too easy now, but no, it wasn't. It was, I think, it was tough. It was a tough call to make. I think we had good reasons for making that call. So I'd like to think we were right for the right reasons. I mean, you all have heard the podcast. You can go back, goodness, a year and a half ago when we started the podcast, episode 1, episode 2, we were talking about, how we didn't think there would be a recession. There was
and literally everyone did. I mean, let's just rewind. People forget this stuff. I mean, everybody did. Any tweets we did, we were hammered. Even today, like yesterday, we're still getting hammered for bots or not. People are still angry with optimism. Call me, whatever.
And so fast forward to now, it's like, okay, I think everyone's on the same page that, okay, economic growth is trending higher. I think if you look at GDP forecast going forward, at the beginning of the year was close to 1.5% or something for 2024. That's more like 2.5% right now, right? So consensus is moved up with respect to growth expectations. And then it gets, okay, where do we think, the pricing has moved too far in one direction? And that gets to what you just said. It looks like markets are pricing in stagflation. I mean, people are talking about stagflation or their rate hikes. No, stagflation, for one thing, is if inflation is up, if unemployment is up, that's stagflation. Unemployment has stayed below 4% now for 26 months.
Right.
Just by that. No, this is not stagflation. Let's be very clear, right? This is not stagflation by any stretch of the imagination. You're not even close to it, right? And then inflation, like I said, the big picture, core PC is running about 2.8%. A year ago, we were close to 4.5%. Big picture is it's lower. Now, it looks like it hasn't gone anywhere for months. That's because shelter is keeping it elevated, right? And a few other things too. But I think the general disinflation trend is down. And,
Hmm.
you
Yep.
know, if you ask me, like you were talking about markets pricing in rate cuts, markets are now pricing in maybe one cut and maybe 50% chance of a second. I would say, we could still see two cuts, right?
Mhm.
And at the beginning of the year, we were in the camp that maybe we see three cuts, could be four, but around three cuts. So we haven't had to shift too much. We've come from 3 to 2. Markets have come from 6 to 7 to less than 2, right? And you can see how fast the narrative, how fast the pendulum shifts. So I think right now the pendulum shifted all the way the other way. Markets are thinking, oh my God, maybe you see rate hikes. And I don't think that's happening, to be honest.
No, I mean, it is an election year, so they do a rate hike in front of the election. Oh boy, I don't think that's going to happen either. They're not supposed to listen to Washington, but we know that's not necessarily how it works. But I know, Sonu, you've got a hard stop here. We've obviously gone probably plenty long enough. Again, thank you so much, everyone, for listening. This is episode 81 of Carson's Facts versus Feelings. Buy in May and stay. We'll be back next week with the latest podcast. We appreciate everybody listening. And let's see. I mean, it's allergy season, right? We were talking about allergies, so people are kind of. You've got pretty legit allergies, right? So I mean, you're dealing with it, right?
I'm like tearing up literally as we speak.
Well, we're done. I mean, you can stop crying now that the pain is over. the podcast is over. So now, all right, everybody, thank you so much. We'll be back next week. Stay safe out there. Things aren't so bad. Don't worry. Sell may go away. It's
Don't
not
do
the end
that.
of the world. Don't do that. And we'll be back next week to talk about whatever's happening next week at that time. See you guys later. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.